I'm going to share my screen and get started. So thanks everyone for joining. This is update for the Virginia CPACE program as well as the Maryland PACE program. So I really appreciate you all being able to also join after the rescheduling. So I appreciate that very much. So we're going to start with Virginia. We can probably make that fairly quick. And I think Ellen and Holly, you all are taking care of any admins, right? Additional people being admitted. In any case, so we're going to start with Virginia, and we're going to do a presentation for Virginia. Then we're going to have some Q&A time, at least 10 minutes, and then we'll do the same for Maryland, so that, each one is distinct. But since, we overlap in terms of personnel, we thought this made the most efficient for everyone. So thanks for joining. Just a quick thing, basically we are going to record, as I said. If you have chat comments, Ellen, Holly, or even Andy also is our consultant, can look at that and respond as needed, or we can do it during the Q&A. That's for both sessions. So starting with Virginia, just a quick overview for those who don't know. The statewide program for CPACE, which is the VA CPACE program, is actually sponsored by the Department of Energy for the state of Virginia. So they are the ones who house the program and issue an RFP, which we responded to with our partner Slipstream, and won that a little over 2 years ago. So in terms of our team here, we've got I'm Abby Johnson, Executive Director, Ellen Dixon, who's a Senior Program and Project Manager. We also have Holly Indiger, who is a Program Administrator in her own right and is our back office contractor for Virginia. We also have Andy Freeman on the call, who's our outreach consultant based in Hampton Roads. And Isabel is also on our team. I don't think she's with us right now, but she helps with closing and other marketing aspects. And Marco also helps us with outreach to both localities and also businesses and developers directly. So basically what we've done, I've been around the CPACE industry a long time. Locally, we've had programs for quite a while, but there were some kinks in terms of the way it was structured legislatively and structurally that we had to modify over the years. And so a little over 2 years ago, we came up with, we won the statewide program, and about a year and a half ago, we opened the consistent, the one program with a consistent set of documents that we're basically getting all localities to opt into and use. So we're not allowing for them to make modifications other than the obvious things you have to do if you're a city or county. And so that's really been well received. Though we have a number of local programs still existing, we're in the process of transitioning them over. Some more quickly than others. It's really bureaucratic, the reasons why they haven't moved over for the most part. And the biggest ones I think that is important to note are Norfolk and Alexandria. Those are the big ones that we're really pushing to get over soon. And we're seeing some movement now, particularly from Norfolk on that. So the goal is to get those guys merged in, and we're going to have 14 localities in our program in a few weeks, because the 14th is passed the ordinance and ready to sign the agreement. And what that means is for you all, your lenders and capital providers, is that you're going to have the one set of docs to use. You don't have to go around getting different legal opinions, which we know was really difficult in our program previously. So here's another just geographical kind of view of where it is. The green are what's in the state program, and the yellow, what's in the local. And I would say of those local programs, the city of Fredericksburg is you could use it today. Obviously it's not the same as the state. It's not as but it has the enforcement done locally. The other ones do not. In the way that the documents are written, it's really not what most capital providers are comfortable with. So really, it's the state ones that you see there. So we just want to give a quick overview of the process. A lot of you already know this, and it's probably similar across markets. But you as a capital provider want to register with us through Salesforce. That's the platform that's housed by Slipstream. We will then market you as a result of that. We will we're going to be starting to do some highlights of capital providers on a monthly basis so that everyone can get out there and get known. But certainly it's important to be on the website. We do promotional activities generally for our registered capital providers and contractors. When you have an application, and we do ask, I know that a lot of times you don't really have the information or the certainty that the deal is going to move forward. And so things tend to kind of get put in the system pretty late in the process, but we would ask to please do at least a pre-app. It helps us. It's very simple. You don't need details except that where it's located and the general amount and things like that. And that way we have an idea what's in the pipeline. And for example, if you have a project that's in a lower jurisdiction that's not enabled, you can still put in a pre-app, and that gives us notification that, hey, we need to move on this county or city. And just for those who may not be familiar with Virginia, we're special. And so, whereas most places, cities are within counties, in the state of Virginia, cities are independent and they are completely separate from counties. They actually act as counties. They bill and collect and enforce real property taxes. So when you say to us, we have a project in, I don't know, the city of Hampton. I mean, is it in the city? Well, actually, that's not a good example. Let's say it's in Roanoke. Well, is it in the city of Roanoke or the Roanoke County, or where is it? So we do actually need to know that, because cities are not within counties. Towns, we are allowing them to use the county process, but not cities. So once you put in an application, we'll go through the process. Slipstream and Holly and her team will review that. We then review it after that. And then we also are looking at the draft docs from you all, and ensuring that it meets, what we've agreed to, which is you've approved the docs. We can't see, substantial modifications of those documents. And then we're going to, basically during this period of time, as docs come through, we're going to let the jurisdiction know they're coming. So we've asked for a 10 to 14 day turnaround time, but we've seen already in the 2 deals in Virginia that have closed that we had it faster than that. I would say that it was a little too fast, in my opinion, for one of them. And I would appreciate that we have a little more time, but I also think it was the end of the year kind of crunch. But certainly, we want to be respectful of the county's limited resources. At the same time, we also understand the needs of, holding rates and things like that. So rate locks, things like that. So we'll work with you as best we can to make it smooth for everyone. But so far, so good. Fingers crossed. We then, we will coordinate the closing with the jurisdiction, and we will ensure that you all then get those executed documents, and then you will, as a capital provider, e-record. We've seen that we believe that everywhere you can e-record in Virginia. There's a lot of, I think it's 137 cities and counties. So, as we are checking, as we're the ones that are enabled in our program, and we're checking, of course, as deals come through, that can happen. But what's great about that, actually, and I'll talk about it later, is it's really, we have very few fees in Virginia. So probably some of the, we have almost nothing. So from a county perspective or city perspective, so that's good from, you think about underwriting your projects. In Virginia, you're going to bill and collect directly. That gives you some flexibility how you want to handle it. You can follow the, 2 times a year of the local government, or you can bill monthly, whatever you want to do. Enforcement, although we know that generally it's better to have the local government enforce, and we certainly offer that and suggest strongly that that's the best way for the market. We have a precedent from a number of years ago from another county, not in our program, that pretty much made it difficult to make that happen. So most local governments prefer to have it delegated to the capital providers. But we've now, with some help from some of you on the call, we were able to do it in such a way that gives the full rights to the capital provider on behalf of the local government. So we don't have this kind of issue with treasurers coming in and trying to kind of take over the process. So you will have those full rights and can certainly charge for the cost of doing that. But there are a few localities, Richmond, one of them, that will enforce. And as I said, we do, we push that as a better option, but we don't want to push it so hard that they say no to the whole program, which is kind of what we've seen so far. Just to kind of, a little rah-rah about our program, we're very broad in terms of our legislative mandate. We can do existing buildings, new construction, raw land. The only thing I think we're a little more stringent is condos. The bankers refused and continue to be against having condos in any capacity included, including common areas. We did get property owner associations included, some kind of like co-op type structures for those common areas. But I would say that in new construction, we can figure it out, right? You'll just, basically pay off that PACE portion as those units come online. So for new construction, we can figure some out. And then in terms of the measures allowed, we're very broad. Well, we intentionally made them as broad as possible. It's better to have it broad, and then if we have to think about something, we can do it at a programmatic level, not a statutory level, which takes a long time to change. So whereas in Maryland, very broad as well, you have kind of here's what's allowed. In Virginia, we have, for example, resiliency includes but not limited to. So we want things that really are in the good letter or the good, in the spirit of these measures, but we have more flexibility. We don't have any SIRs, savings to investment ratios. We don't have any caps. We don't have any specific requirements amongst the kinds of energy audits, things like that. We use, what best, best policies, best practices through programmatically. We have retroactive financing. It is currently capped at 2 years. That was at the insistence of our state government. That being said, we have managed to do it in such a way that if you pre-apply, that's when that clock starts. So for example, if you completed at the end of 2022, and so now you have basically you're already over a year into the retroactive financing, as long as you put in a pre-app before the end of this year, you've met that requirement. Now, I think, and we've talked to some lenders where they don't want that to go out indefinitely, but at least helps extend the period beyond 2 years. And again, as I kind of pointed to earlier, basically we have no locality fees. We basically make that a non-starter for them, and they've seemed to agree. So they're not doing as much either. They're not enforcing most of the time. They're not billing and collecting. So they've agreed. And so the only thing you're paying is a very low in the recording fees, which we've seen, depending on the number of pages, is somewhere around $75, but we're saying under 100 to be safe. So basically nothing. You can e-record most places. And, we're really fast on our end when we get things in, but we do ask, and Holly's on the call too from Slipstream. We do ask you give us some time when you get docs in, please forward them to us, put them in the system, I should say, put them in Salesforce so that they can start their review. So we're not, trying to do everything at once in one day. That's a lot for us to do when we juggle multiple programs and projects. And, our program guidelines, I know that that's not something that everyone wants to necessarily look at every night, but they are very detailed. You can go to one specific section, click on it, hyperlink it. So it is pretty user friendly. And we do also, talking to other entities like USDA or local USDA or other kinds of financing vehicles in order to try to help, see what other things could help make a project pencil. So initially, just updates, mainly updates, because we're pretty new, is that we closed 2 transactions at the end of 2023, and we're excited about that. And so we see more excitement around the program. Our PR is really going well. We're really going to push for some direct marketing efforts to try to increase interest in the program around resiliency, which is big in Hampton Roads, around directly contacting property owners. For example, one example is Lego. We just heard that they've now stalled because they don't have the money for some of their energy initiatives. So we're outreaching, talking to the economic development director in order of that county to really see if we can at least get them interested, and then we'll have them be aware of the list of registered capital providers. One last note, and I'm on the board of Virginia Housing, that's the state finance authority, and I did talk to them on Tuesday about their PACE interest. They have senior loans that are usually construction loans that are part of the capital stack with their low income tax credit projects. and even other projects that don't have LIHTC, and they're, they're pretty conservative, as it makes sense, but they are willing to look at it on a case-by-case basis. I'm still going through all the, the detailed questions they have, but I think that's a positive sign that they're willing to consider it. I think a few of you have asked about that. Two other quick notes. We are at this point limiting IO to 3 years. There's 3 years of cap I, 3 years of IO, that's 6 total. We will consider, outside of that, there's a good argument, but we just think that's best practice is what we've been asked to do. So that's it for Virginia. I'm right in that 20 mark and try to speak quickly because of the fact we started a little late. So I'm just going to open it up. Let's see, are there any, I'm going to stop sharing so I can see everyone and just see if there's anyone has questions. I don't see anything in the chat. So does anyone want to ask a question? Just go ahead and unmute. Y'all shy today? Does my team want to add anything? Ellen or Andy or Holly? Wow. All right. Does that mean I really covered it all for you all? Okay. Well, Holly, you want to say something?
No, you just did a very good job, Abby. So we don't need to chime in. I just didn't want you to feel all lonely out there. We're listening.
I thought of a question.
Sure.
So in Virginia, does the first mortgage lender has to subordinate, correct? An actual subordination agreement?
Yes. You
So
know better than anyone.
Yeah, I know. The two deals you closed late last year, how hard was it to get the first lender to subordinate to the PACE lien?
That's a great question. If either of the lenders on the call feel like answering that, they were the ones who handled it. There's certainly representatives from one of them, I think from both. So if anyone wants to come online and just say how they felt the process was, that'd be great. If not, we can say that it seemed to come through when it came through, and there wasn't any backlash once we got in the docs. But I don't know if anyone from Nuveen or Pace Equity feels like chiming in. If not, that's fine. I can't see everyone, so.
Hi, this is Horatio Chacon with Capital Bank. We are a community bank here in Rockville, and I am coming up against that hurdle, especially if there's a large mortgage ahead of us that the first lien holder many times doesn't even acknowledge me, and the deal dies at that point. And I just wonder if there's anybody has any secrets out there that may help me overcome that obstacle, because that usually kills my deal.
Well, this is Ellen from the program. I mean, we have started adding under our capital provider page on both sites the list of lenders who have already done lender's consent for PACE programs. So that's one list you can always look at. But other than that, I mean, we have not necessarily gotten involved in those type of negotiations, but I'm not sure how banks get it through, but we do see it come through. So
Well, we're happy to help. I mean,
yeah.
I think some of the PACE lenders are extremely familiar with the process, but if you're a little newer to that, we're happy to be on calls with some of these community banks. I would say that certainly, generally, they're concerned about the risk, how to mitigate it, and there's ways of doing interest reserves. There's ways of, they can put in their own underwriting standards that may be more stringent, that maybe limit the PACE amount, but will allow them to consider it. We do see, I forget whom I was speaking with, probably someone on the call today, about the fact that by having PACE in there, you're really actually lowering the risk for their asset, and that they can see even a benefit of potentially having some of the deposits. Actually, I know who told me that. I think it was Andrew. That they like the idea of having some of the deposits that you can keep in escrow. So there are some creative ways of trying to get lenders to consent, but it certainly always can be a challenge. I mean, they're pretty constrained right now. I'm finding it. I've been told by our capital provider partners it's becoming a little easier. But I'm going to stop talking. Let someone else chime in.
Well, I just want to clarify Bill's point, I mean, it's subordinate, but only to the annual amount due, not to the full loan amount. So it's a, you know, it's a secondary position, but not to the entire PACE loan amount. It's a secondary position to the annual assessment amount, similarly to the way they're subordinate to the annual taxes. So
So what happens in a prolonged default? Like, at what point under the law can a PACE lender foreclose? Is it after a year or after 2 years? Help me understand that.
Yeah, it's based on, you recall, I think, I'm trying to remember now. I think cities are 1 year and counties are 2. Virginia, unlike other places like Maryland, has a tax lien sale process. It's pretty fast. We have to wait that time. So, I mean, in that process, we're certainly hoping the property gets sold or bought by someone else who'll make the PACE lender whole. You know, but obviously
but they
we
don't have to make the PACE lender whole. They just have to bring the assessment
That's what
up
I
to
meant.
date.
That's
Yeah,
what
yeah.
I meant. That's what I meant. They had to
yeah.
make they have to make whatever's delinquent whole. Yeah, well, that's what I meant. Yeah, but you're right.
Yeah,
It's very important to keep saying no, but you're right. It's important to keep saying that because that's very easily understood by us, but not by the other people, other lenders.
Right. Yeah, what I'm noticing now is that as interest rates go up and cap values go up with it, and values start decreasing, there seems to be a
This is the
hesitation.
kind of shit that I'm like.
There's
Sorry.
a hesitation from the mortgage lenders.
Yeah, because they don't, they may not see the value that was originally approved.
I think there's hesitation
Oh.
from mortgage lenders on every aspect. We did half as many loans in 2023 than we did in 2022. I mean, you know, it's definitely a tough lending market as a whole. So
Yeah, they're pulling back a lot. Well, some of our capital providers on the call that are, been active for a number of years, do you all have anything to chime in on what you're seeing? Or we don't have to have this conversation now, but since we open it up, certainly interesting.
Hey, this is Bali from Pace Loan Group. I
Hey,
mean, I'm
Bob.
just seeing that a lot of deals are DSCR constrained. So we have to work together with a lot of senior lenders to determine like what the appropriate capital stack would look like, including PACE or not including PACE, in order to ensure that the total debt DSCR doesn't go below whatever threshold level.
Would you
With
say
interest
are
rates being
they at
higher, it's a lot
1.2,
harder.
1.25 now, would you say?
I mean, depending on the asset class, typically whatever the senior lender is underwriting to for a total debt DSCR, we'll probably be comfortable with.
Right. Yeah, it's usually they're the ones who are
So if
more
it's like
stringent.
125, then
So
fine.
1.25 now. Oh my gosh, the old days was 1.1, California 1.05. Thanks, Molly. Anyone else? Well, going once, going twice, you guys can certainly all and gals email us here anytime about our program. You can go to our website, virginiapace.com, and ask us anything else about the program and how we can help, you all market it, use it. Certainly we're ramping up. We're excited about these projects closing. It really, I think, helps create a good narrative because it just took a while. We opened basically during the interest rate, accelerated rise. So that was not the best time to be opening, but thanks to our lenders also, Nuveen and Pace Equity for getting it done. Appreciate working with them. So I'm going to transition.
Abby,
Yes.
Abby, we have some questions in the chat.
Oh, okay. Thank you. I can't sit. Can someone, I have my, I'll stop sharing just so I can see.
I think,
Oh.
you don't have to mention that. I don't know if that's.
Well, Don, yeah. Hey, Don, how are you? Basically, we think Norfolk's gonna, well, Andy, you can talk about Norfolk, right? We've got some good updates, I guess, about them moving along.
Yeah, we expect Norfolk to act on the state program. They already have a local one, but they're supposed to be moving toward the state program, I would say, this spring.
Okay, that's great. And then other than that, Winchester, we're working with Alexandria, get them in the state programs, just some kinks because their ordinance didn't they amended it, but they didn't fix some of the things they need to do. And then we're gonna make an outreach push for a lot of localities we've talked to in the past, like Spotsylvania, Stafford. We're trying to get Fredericksburg into the state program. And then we're going to work on where our lenders are telling us they have deals like Brunswick and Bedford and Stanton, things like that. So we're out there sending letters and refreshing and emails and making calls, but we focus on where deals are. We do have some that we think are going to be a little hard pressed. I mean, I think we'll get Hampton because we have a grant for that, but like Newport News, not so sure. Suffolk seem it's a little hesitant right now. So we can certainly talk offline, Don, given we're all here about that. I know we're at the time now. Does anyone have an answer to Holly's question? Know about that? Wells Fargo consent? Well, let's just move on. And then if you all know, you have Holly's info to email.
Apologies, I just joined. What was the question about Wells Fargo consent?
Did they consent to a deal in Texas?
They have not consented to a deal in Texas. As far as I know, they've only consented to one CPACE deal, which was with my firm in Philadelphia.
Okay. And who are you with again? Are
Oh,
you with
that's-
Northbridge?
I'm with Northbridge, yes.
Okay. I think I saw. Hi there. Hi. You go by Ben or Benjamin?
Ben.
Okay, nice to see you. Nice to talk to you. Okay, so thank you for that information. I think in the interest of time, we're going to move on. So I'm going to pull up the other PowerPoint. So anyone who's not interested in Maryland can leave, and hopefully you all are, because most of you are national lenders. So I'm going to share the screen there. Okay. So it may seem like somewhat the same crew. At least Ellen and I are the same crew. But Abacus, is for-profit. Virginia PACE Authority is a nonprofit. Abacus, a for-profit that runs the MDPACE program in Maryland. That excludes Montgomery County, and Prince George County. But we do work with Montgomery County, at least. We certainly share information as much as we can. So here's a team there. I don't know if Dan, our colleague, is on the call today, but he's also part of our team. And so you can see that basically Abby, Ellen, and Isabel are the three that bridge both programs. And in the similar situation, our sponsor is the Maryland Community Center. They're quasi-governmental, but they are statewide, and they're also a CDFI, and also, so they have state level reach. So in Maryland, you can see the program opened up a number of years ago. We took over the program. We applied for that position as well, but have been running since, I believe, 2015, 2016. And that was with PFS, PACE Financial Servicing. And so a few years ago, about 2 years ago in March, we fully took over that program. And what we've been doing is basically try to get, these localities, all the ones in green are enabled, but get them to update and amend their ordinances to the improvements made a few years ago statutorily. So as you all who've worked in different areas know, this all takes time, but we're making progress. I'll get into that a little more later. So speaking exactly of who's updated, 5 have updated so far, and they are certainly 2 of them particularly are big counties, Howard and Baltimore. We're certainly going to do a push for some of the other really big ones, particularly Anne Arundel in the city of Baltimore. City of Baltimore has a little more flexibility in the way that they've structured their program based on their charter, but we certainly want to get to a point where we have the SIR removed everywhere in the state. And we have some of the limits on term as well. That was the 2 big things that we see. Also clarifying the ability to do refinancing, retroactive financing in Maryland, which it's allowed in Baltimore City, but they've passed their ordinance in such a way, and it's not, excluded, but it was much better to have it, put into the state statute, which is what was done a few years ago 3 years ago, before we came on board. So that program is closed about 125 million, half of which in Baltimore City. But now that we are pushing to other jurisdictions and doing outreach, in part for this amended ordinance process, we are seeing projects in more counties. So that's exciting. We have closed in Wacomico, for example, in the Eastern Shore, Howard County. We have some projects brewing in both Charles, Washington, Hartford County. So we're definitely looking at different areas of the state to try to really to not just be so Baltimore centric, which is great. Baltimore's great, but there's more to the state than Baltimore. And just a really important point, which we don't have this issue in Virginia because we're really at this point only doing the state program. The local ones are being transitioned out. So we have a program guidelines on our website. Those are the ones that you should be reviewing. But there's going to be situations where the ordinance of that jurisdiction takes precedence. And we say so in the program guidelines, but we just want to clarify that, you know, that's the way it is. So if the ordinance says there's a term limit, we can't do the weighted average, and that's that. So the ordinance always takes precedence over any guide. But there's a lot of other things in the guide that were more clarifying, more detailed, we feel like are helpful. But just to keep that in mind for those of you who are a little newer to the program. Process is very similar to our Virginia process. We have a Salesforce portal, which is managed by SCF, our subcontractor in the state. And we ask again that you do the pre-application just so we know where it is. And if it's, and it could be in a jurisdiction that's not enabled. And we would certainly, want to know that so we can try to really make a push. Most of you all call us before that, but it's still helpful to know what's going on. And then as you get docs in, please submit them in our Salesforce portal per the checklist. And in the same process, we let the jurisdiction know much before, once we hear from you all, there's a project, we let them know there's a potential project, and we keep them updated very regularly so that it's not a surprise. And that they know the kind of project we go over if they need a refresh on what the docs are, things like that. One thing I did not mention in Virginia, which I should have mentioned, honestly, is what gets recorded. It's in the deck, and I'll certainly send it to you all. But in Virginia, we're recording what's called, you have your tri-party agreement that you sign between the capital provider, the jurisdiction, and the property owner. A shorter version of that, called the MDPACE lien certificate, gets recorded, not the full program agreement. In addition, in Virginia, because of subordination issue that the bill mentioned, Bill Greenleaf, who with me helped get this legislation over the finish line many years ago, we are required to also have that lender consent discoverable. So that gets recorded. And if in that locality they're assigning the rights of enforcement to the capital provider, that document gets recorded. So, I won't confuse things, but those are the three things that get recorded. In Maryland, the only thing that gets recorded is a statement of levy and lien, which is the equivalent of the tri-party agreement. It's Maryland tri-party agreement, except for the city of Baltimore, which also requires that the financing agreement between the capital provider and the borrower gets recorded. But other than that, it's just the SLL. So they're really just looking, as we call it, statement of levy and lien. That's the one document that they're reviewing. It's going to have your AM schedule, going to have your terms, things like that. So in any case, same way, we get the docs, we do the final review of what SCF has provided us, the preliminary approval. We review that. We look at the legal docs, make sure things are in order, not substantially changed. We send them to the county. The county, we work with the county, get them to sign hopefully as quickly as possible. We've gotten some pretty good folks who have moved things along. Again, we still ask for that time period. Most localities will allow a slip sheet, not all. So we try to manage that as well. So in Virginia, we're really kind of just telling them that if it's going to take a certain amount of time, that they got to do a slip sheet. So because they don't really have prior knowledge of the process. So far, so good on that. And then again, we help coordinate the closing. And the same as in the new program, we are requiring that the capital provider record versus us, and in-recording is generally available. The big difference between Maryland and Virginia is that the PACE assessment is basically either on the property tax bill or sent separately, but it's basically billed and collected by the county. or the city of Baltimore. So it's not done by the capital provider. It's the servicing is done by the program and the jurisdiction. It was the way it is when we came in, and that's certainly, and the enforcement is done by the counties. So it's more of a traditional PACE program, if you want to call it that way. I didn't double check, Alan, is that number April 30th is correct? I believe it is for delinquencies, but the other numbers for sure are. Most jurisdictions bill by the end of June. They're due usually by the end of September, except for Anne Arundel, which is twice a year. And they're supposed to remit them within 30 to 60 days, which is not always as straightforward as it might seem, because PACE is kind of like not necessarily, it's one or two of those where they're hundreds or thousands of, property bills that they're, collecting. So we stay on top of that. We're that interface between the paying agent and that actually gets the money from the county and the property owner and the capital provider. So we're not the ones who handle if there's a delinquency. It's for the documents. It is the lender who's required to do that, but we try to assist where we can, try to, provide as much information as we can. We know, but just to make that clear that that's something that's the capital provider's responsibility if it goes into delinquency and in default. The good news is it's fast. It's fast in terms of tax lien, in terms of hopefully making whole more than other places around the country. Similarly to Virginia, as I said, broad measures of eligibility. It is more prescriptive and what they're listing that's eligible, but it's still very broad, in terms of resiliency. So I find it, so far, we haven't seen anything that didn't qualify. Refinancing has been added to the program. We would have preferred the word retroactive. Refinancing suggests, really refinancing existing debt of some kind, but we did talk to our IG about of the state about that, and I think we're pretty comfortable with letting that be more broadly interpreted than the word itself. I don't know. I realize I didn't really give time for Ellen. If she wants to chime in so far about anything.
Nope, I'm good.
Okay, and I don't know if Dan's on. Is he on? I can't really tell, but if he's on, he can certainly chime on the program. All right. E-recording is available in most places, which is simple file, which is great. Helps, and we've seen that work the last number of deals we've done. And is similar to what we have in Virginia. We've modified the docs. We cleaned them up as much, they were good docs, but we just wanted to try to update them for the new standards and try to clarify some things. So they are not highly modifiable. We will review quickly, just like in Virginia, but again, please provide us information. We are now, so in Virginia, we have an internal review of that's done by Slipstream of our of the energy analysis or project analysis you provide. In Maryland, currently, we've had a system where a technical reviewer will approve the deal, but there was less requirement for actually showing energy savings and water savings and quantifying those. And now we are requiring that. That's something that is absolutely mandated. I mean, we think it's a good policy, but it's been mandated really by the state to have that. And with the statewide building energy performance standard coming out, I think it's going to be something that everyone's going to be doing anyway, but it's something that we now require. So what we're doing in the last number of projects is really piloting the idea of having it done internally in such a way that, you don't need the technical reviewer, because some capital providers just do an energy audit anyway. So that way, they're not having to pay for a technical reviewer in addition to the energy auditor, because they're already that's included. But for those who don't, the technical reviewer has been an option. So we're piloting doing it internally. But in any case, we do need a PE to be reviewing and creating the docs. And one thing I mentioned for both programs is we have them in Virginia. We really ask all of you, when you do projects in our jurisdiction, we have a form that says what's allowed to be, marketed. but it helps everyone. If we have the ability to do a press release with you guys or to do case studies, have a little more detail about the project or have a ability to get a quote from you all or from your sponsor, it really helps the program and you know, and get the word out. So we just ask that we can even collaborate more than we have in the past with you all. We do have some changes we're doing to our program structure in addition to what just the kind of overall benefits. And so what we decided to do is because of the way we're seeing the program evolve, we're going to tier down right now our closing fee is uncapped. We're going to tier that down. We're in the process of finalizing that, but we're going to tier that down for amounts over 10. If you think about the Texas program, it's not exactly the same amounts, but that structure where amount over 10 million would be charged at a lower percentage. We're going to start doing that. And we think that makes sense. At the same time, we're going to be having to increase our annual servicing fee. We're just our costs are higher just for servicing, much higher than what's currently in place. So we have to increase that, but we also have to take into account just the amount of work that we have to do regardless of whether a deal closes. So this is a way of just really making the program viable, which we all want. So we try to balance the, you know, reducing the upfront fee for larger deals with the annual servicing fee going up. And we've also, based on our experience the last year in particular, decided to have an application deposit. This is completely refundable, or not refundable is the wrong word. I keep saying that, but it's applicable to the program fee if the deal closes. But what happens is there's been a number of situations where we've really spent an enormous amount of time on the project, and then it doesn't close and we've got nothing. And there was an application fee before, and we tried to look at not having one, but instead of having a fee that's non-refundable no matter what, we're just saying we need something up front, help pay, just the costs of doing the review, often including the energy analysis. And then if the deal closes, we'll just, subtract that out from our fee. And then I just want to clarify, maybe it doesn't matter for most of you, but the term should commence at when you have the project, C of O or project completion. So that usually works fine because payments are usually done in a way that kind of mirrors that. But for those who want to push out the CAP-I and IO, I think it's great. I just don't want, to start having a term of, you don't want to have a HVAC unit that's got a 20-year life that really is only starting to be, it's going to basically be longer than 25 or 30 years based on when you actually push out the term. So that's kind of weeds and we can go into it and talk about it. It is programmatic, not statutory. So we're certainly flexible to hearing and trying to make deals work. We're really trying to be balanced in the way we look at things. I think there's someone waiting in the lobby, by the way. And that's it for that. And we have our email. It's the same, I should say it's Abby. We could have, I think, the state sponsor likes everything to go through our info email, but I think most of you have our emails, Abby@abacusprop.com, Ellen@abacusprop.com, Isabel at abacusprop.com, Dan at abacusprop.com. So you can certainly contact us that way as well. So I'm going to leave this up for a minute and then actually, and a little bit early. So I just want to open it up for any questions for anyone on the call today or any comments by our team. And I'm going to stop sharing so I can see everyone and start calling out people that I know. Does anyone want to comment on what they see in terms of Maryland, what areas they see the most interest in or growth, or where they would like to focus, or what they need to know about the program that is confusing to them and would like us to answer? So this is the kind of questions we'd love to answer. Particularly for those who don't know. Hey, Horatio.
Hi. So I am fortunate that we have the Montgomery County Green Bank here. So I use them to, you know, answer my basic questions. But one of the things that I've been trying to expand on is getting our property owners, and this is probably something that is hard to answer, but, you know, getting our property owners just to acknowledge the fact that they're going to be required to have some higher standards in their buildings coming up shortly, if not already. But I can't seem to get any traction with Montgomery County.
Oh, interesting. In terms of them marketing trying to explain to property owners in terms of
Oh,
marketing?
not the Green Bank. I'm sorry.
Oh, you mean
The
the actual
the
property
property
owners?
owners. Yeah, yeah. I
Yes,
get a
yeah.
lot of inquiries in Baltimore City, but Montgomery County, um, I get the initial phone call and then it's crickets.
Regarding their interest in using CPACE in Montgomery County.
Or even pursuing a CPACE loan.
Okay, so what is it so you don't know why they don't even explain it?
I just can't seem to get to, you know, past first base.
Yeah.
And so bad analogy, I'm sorry.
That's
But you know,
okay.
one of the, so one of the questions that I have is if folks are lending out in Montgomery County or have had some success in Montgomery County, you know, what are they doing? Or if you guys have seen anything in Montgomery County, you know, what are possible secrets that you can share with me?
Well, just to be clear, we don't run that program, as you know, but I mean, there are some lenders who have worked in the county in the past. I do think that I don't know how to put this, not getting into trouble. I think that maybe the county has a reputation. They had some different kinks in their program, like they weren't going to put the lien on until after construction was complete, and that's changed. But that and maybe I think they rejected a deal a number of years ago. That kind of maybe sours property. They don't know anything else. They don't remember what happened since. They just know that. So it's possible there's some kind of legacy issues with the way that the program was legislatively structured that could lead to that. But outside of the city of Baltimore, obviously, is in our territory. So if please, you know, again, we tell all our lenders, we're not trying to get in your business, but if you want us to be involved and trying to just explain the program and the benefits from an agnostic standpoint, we're happy to do so, of course. You know, if that can make any difference. You know, we both worked in the side of you know, before we were administrators, I worked as a project developer and was in commercial real estate before that. So I understand. I was actually an underwriter at some point, so I do understand briefly because I couldn't do it. Sure. But it was, you know, you understand their risk ratings and how they're mitigating risk. And so I can speak that language. That's helpful.
I would just say from my perspective, since I'm the one that takes the calls from the info line on both states, I would say that 80% of how we hear about deals is really through the lenders. The rest of it will be maybe jurisdiction will call us and want us to help have a meeting with a property owner, which we are always more than glad to do. And then the rest of it are just property owners themselves who reach out to us. So we are always glad. And I think Abby didn't touch on it, but we do ask if we can in the beginning of a project when you've put in an application that we try to have a meeting or we'd like to have a meeting with you and the property owner so that everybody can understand how it works, what the documentation is. You know, that does help when you're also looking at lender's consent. I mean, we have some of those meetings in the beginning, and so everyone is on the same page. And we are always more than glad to talk to property owners about what the program is and what it means. I think we see this with jurisdictions too. I mean, I think it's just the education of the program and people just not understanding what it is. And I think once that they see that it's something that's a nice benefit, especially a jurisdiction, it's an economic development tool, a property owner, it helps them with the capital stack. It usually helps move that over the finish line. So we're always more than glad to do that.
Very good point. Yeah, I think that is really important to say. I mean, we're not trying to like force a kickoff meeting in order to, again, kind of get in the way. We just think that sometimes it helps sell the business. But, you know, Horatio, I don't know, are you on our original list? Because I want to make sure that you know how to contact us, because I feel like we would, you know, maybe you're a little newer to the program. We'd love to help you.
Yeah, I am not. But now you have my email address, so please,
I don't, did you put it in the chat? So we have it.
I'll do it right now.
Okay, thank you.
And one last thing I'd like to say to my capital providers who are still on here. If you've not put in your limits on the website, I mean, most of you have them, but some of you don't, or if you're changing them, please let us know, because I do, when I get projects in and there are a million, I mean, we don't really recommend any one in particular, but if somebody has just $1 million, they just are looking at $1 million or maybe 800,000 to $1 million, you know, I'm not going to have them waste their time calling those of you who are 2 million and over. So it really helps for me at least to know what your limits are when I get some of those calls in like that. So just a reminder, gentle reminder.
Anyone who has any statutory questions about our state, or any questions about anything even like gentle, you know, critiques for those we've worked with. We're happy to hear these things. You know, we're trying to, you know, balance good energy, clean energy policy, economic development, and, you know, local governments, contractors, you guys, property, you know, it's a balancing act. So this is an open forum to just talk about what you want to talk about for the last 4 minutes. Anyone feels like doing that. If not, we can end early. After Horatio puts his info in the chat, which I don't see yet. Well, Horatio, why don't you just email? I don't see the chat. Am I missing it? Why don't you just email? Oh, there we go. Yeah, there you go. Thanks, Ellen. Just
Sorry.
email Ellen. It's okay.
Yeah.
Oh, there you go. Oh, you work with okay, you work with Evan. Okay.
Yeah,
All
but don't
right.
tell anybody.
Don't tell anyone. Tell him hi.
I sure
All
will.
righty, great. Well, thank you so much for your time today. I really appreciate a lot of you staying on to the full end, and we will send out the recording as well as the presentations afterwards. So thanks for joining again, and have a great Thursday.
Thanks, everyone. Bye.